If you've ever tried day trading, you know the feeling. You stare at these screens, watching the flicker of the candlesticks, waiting for a magical combination of lines to tell you exactly what's going to happen next. Your chart ends up looking like a neon spaghetti spill. You stack MACD histograms under RSI bands, hunting through all that noise for the perfect buy signal that will guarantee a profit. Large-scale ablation studies have recently put these indicators to the test across thousands of assets. The data shows that when these indicators are used to forecast future prices, they struggle to outperform the most basic buy and hold strategies. This is a chart showing the forecasting accuracy of a deep learning model. Notice what happens when researchers plug standard momentum indicators into the neural network. The model's performance actually degrades. The AI gets confused by the noise. The reason is simple. Indicators are deterministic mathematical transformations of past prices. They rearrange historical data. They don't conjure new information about tomorrow. Which brings up an interesting paradox. If these formulas are useless for predicting the future, why do professional quantitative traders still rely on them every single day? It comes down to how you use the tool. Amateurs use indicators to guess where a price will go. Professionals use them to measure exactly what a price is doing right now. To actually understand a market trend, you have to abandon the idea of forecasting. You have to stop acting like a psychic and start thinking like a physicist. Treating the market as a complex physical system allows for a shift in perspective. While the future trajectory remains elusive, the current kinetic state is something we can precisely measure. The bedrock of all technical analysis relies on one simple premise: asset prices move in persistent, identifiable trends. This market behavior maps directly to classical mechanics, specifically Sir Isaac Newton's first law of motion. In physics, an object in motion stays in motion until acted upon by an outside force. In finance, a price trend remains in uniform motion until the external forces of supply or demand step in to stop it. The problem is, if you look at raw daily price action, it's too jagged and chaotic to see that underlying motion with the naked eye. This is a scatterplot of raw market data. To make sense of it, we use a moving average. This tool smooths out daily volatility, slicing through the noise to calculate the data's true slope. That slope gives us our first physical metric, velocity. It tells us the trend's current direction, showing whether the market is drifting upward or grinding downward. Identifying velocity is a great start, but it only tells us how fast the asset is moving at this exact second. It doesn't tell us anything about the force driving it. For a trader, velocity alone is a trap. To survive, you need to understand the underlying pressure, the acceleration, that is actually pushing that trend. This is where the MACD comes in. The Moving Average Convergence-Divergence Indicator has a reputation as a magic signal generator. In reality, it is purely a gauge for acceleration. The math is elegant. We take a slow historical moving average and subtract it from a fast recent one. By looking at the space between these two speeds, we extract that difference to isolate pure momentum. When this MACD line pulls sharply away from its signal baseline, it means the short-term slope is getting steeper. The price isn't just moving up, it is accelerating. Conversely, when the lines curve back toward the baseline, the trend is decelerating. The velocity might still be positive, but the physical market pressure is dropping. Other popular momentum oscillators, like the Relative Strength Index, perform this exact same mechanical function. They measure speed to detect when the market is becoming exhausted. By mapping this underlying acceleration, these indicators reveal hidden exhaustion in the market. They show you that the pressure is fading long before the actual price direction of the asset ever reverses. Once you grasp this, your trading software interface transforms. It stops looking like a crystal ball and becomes what it is: an instrument dashboard. Every metric maps to a physical property. The current price represents your exact location. The slope of the moving average represents your current speed. And the oscillator underneath represents your current acceleration. Take the classic MACD crossover. Rather than attempting to guarantee a rise tomorrow, this signal provides mathematical confirmation that downward pressure has exhausted itself in the present moment. True professional technical analysis is never a gamble on future events. It is a precise diagnosis of present physical conditions. Focusing entirely on measuring current pressure replaces the anxiety of prediction with a steady, measurable rhythm. You move from guessing to measuring. Successful quantitative traders simply observe the data. They look at the math to determine whether buyers or sellers are currently applying more physical force to the system. So the next time you open a chart, apply the physics. Check the slope to see who is in control of the trend. Then check the acceleration to see if their grip is tightening or slipping. Stop trying to predict where the next candlestick will form. Success in this framework relies on trading the verifiable facts of the present.